Hello and welcome to Pro Trader Strategies Market Commentary for Tuesday, January the 31st. My name's Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these daily market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies that you can implement into your portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters, I don't know what's in your portfolios, and therefore what I'm doing could be counterintuitive to what you are already doing. Having that out of the way, let's get this on. We've got quite a bit of economic data going on today across the pond. In Europe, we had the French preliminary CPI number come in at negative 0.2%, was expected to be a negative 0.5%, so that's a little bit better than expected. We also got Spanish flash CPI coming in at 3%, was expected to be 2.4%. Then we got the German unemployment change was negative 25,000, was expected to be negative 5,000, so that was better than expected there. We also got Italian monthly unemployment and it came in at 12%, higher than the expected 11.8%. That's not looking too good there. But then across the overall Europe, CPI flash estimate came in at 1.8%, was expected to be 1.5%. Core CPI flash estimate came in right in line with expectations at 0.9%. Then the unemployment rate for Europe was 9.6%, lower than the expected 9.8%, so better than expected there. Got a couple of numbers coming out of Canada, which was GDP came in at 0.4%, was expected to be 0.3%. Then in the United States, we got employment cost index came in at 0.5%, lower than the expected 0.6%. So that being lower is not alarming, but it is not as good as what was expected. Then we also got the Chicago PMI number came in at 50 versus the expected 55.1. Now remember, the PMI number there on the Chicago is anything above 50 is expansion, anything below 50 is contraction. So just treading above that 50 line with the 50.3, but lower than expected, isn't showing a lot of progress to the upside or expansion. So that was lower than expected, so not too good. Don't know that that was actually a leading indicator of what was sending the overall markets down, but it is not a good signal for the economy because the PMI number, remember, is Purchasing Managers Index. It's very forward-looking. It's one of the numbers I look at the most because the PMI is forward-looking. It's not a lagging indicator in a sense. So it is what the purchasing managers are expecting for the economy going forward. So it's a really important number in my eyes. Then we also got CB consumer confidence came in at 111.8, was expected to be 112.6. So that's lower than expected, showing consumer confidence not as good as they were expecting. And previous months consumer confidence got lowered as well. So not too good there. One thing we got going on later on today at around 7:30 Eastern is the Japan final manufacturing PMI number. So keep your eyes out for that. That could be a market mover overnight for some of the equity futures, if you will. All right, so anyway, on to the overall markets. We've got crude oil up again on the day, up about 70 cents and right at that value area high, that line in the sand I think I've been talking about for about 3 weeks now, it seems like. But that $53.50 line in the sand is acting as a moat, if you will. It's a pop above, or it's really acting as resistance to the upside. Then on to gold futures. They are screaming higher today, up $18 on the day. This is going to act as resistance now that the bulls have gotten above the 9-day and the 50-day moving averages. I've talked about this. I think the next target is that 200-day moving average, but the next line in the sand to get through is about 1220. So that's going to be a resistance area. As you can see, that acted as a double top right here, and was very difficult to get through. That's when I thought we were going to really go test it about a week and a half ago, to go up and test that 200-day moving average. Looks like we're back having that target in sight as we speak. So as the equities come off, it's a flight to safety into gold. So you're going to continue to see strength in that if the equities continue to show weakness. Same with the bonds. Bonds up 19 points on the day. They're going to show strength as the equities show weakness. Again, flight to safety, if you will. Right now, trading just above that 9-day moving average. That's going to be important to note, because if it can settle above there, it's going to look like the bulls have more of room to the upside, and will probably again go up to test that 50-day moving average that we did a couple of weeks ago there and failed. That's when we broke down. Now we're eyeing that back up again as we start to see a little bit of a bounce here. Also, one thing to note is we really have to get above this 154 to show a bullish trend coming on, because as this comes, as we've bounced off the low, sometimes we call that a dead cat bounce in the on the floor. It needs to get above that to kind of confirm to the upside as well for a charting aspect. So if it just kind of fails and drops down, it's really called a dead cat bounce, and we could see new lows. Then on to the Dow Jones Industrial Average, right now down 156 points on the day. Yesterday, we late in the afternoon had a nice big rally. It was making it look like we were going to have some support here. It came back above this trend area and above the 9-day moving average. Today opened up below yesterday's close, almost a bit of a gap from the close, and have seen nothing but weakness for the most part throughout the day. NASDAQ again also showing weakness as it's down over 37 points and very near the lows of the day. Again, we did have a little bit of consolidation on these lows and a bit of a bounce that we'll see on the 15-minute breakdown of the E-mini S&Ps, but as we are right now, the overall markets, broader markets, are continuing to show weakness. And talking about those value area highs, I think that that's the target they have in mind. If we can break below this little trending area, that's going to be the one that really is the target and the next support level, and what the bulls will be looking to defend quite rigorously. But the E-mini S&Ps right now as we speak are down just over 11 points on the day, but very near the lows. We can see it on a 15-minute chart. As you can see, we actually just made new lows in the last 15-minute bar. This is a 15-minute breakdown of the E-mini S&Ps, and as you can see, overnight the overall markets kind of trended lower, but coming into the day session, we really just have seen nothing but weakness from that point forward. There's been a couple of bounces here and there, but that has been with very little volume to the upside. So the real volume nodes are coming in on the sell side here. So the E-mini S&Ps not looking very strong at this point. So nor are any of the equity sectors. As for some of the things that I've done, I talked about this trade yesterday in the daily market commentary, and it was with the Deere trade I had on the March 95 110 call spread in there. So I actually was long the 95 calls and short the 110 calls. That market rallied up quite nicely for me. I was directionally correct on that. Yesterday's sell-off, I decided to start putting in a trade for that, trying to get out of it at $10.50. Didn't work out that way. I had to actually chase the market down. Finally got filled at $10.40. So made a nice little profit on that, because I originally paid $7.48 for that trade. Not quite in line with 50% of my max profit potential on that trade, but as the overall broader markets were starting to sell off, I was getting a little bit more bearish, maybe seeing a little bit of a topping pattern in several different markets. So wanted to make sure that I bagged my profits, whatever profits that was, before it got worse. Now I hope that you guys kind of followed suit with that. It's very close to that price now. that you can probably still take advantage of that, maybe even get a little bit better with some of the theta decay, since we are back in that range or that area that I looked to cover that yesterday. So out of Deere, ticker symbol DE. Qualcomm. Now, Qualcomm, I talked about this in the long call butterfly webinar on Friday. Now, I looked at it yesterday as the markets were coming off. I was like, hey, this is actually the target for Qualcomm. I could easily see it break down. I talked about this after their earnings. They have a tendency to make a big move on that earnings announcement and then settle down, as we've seen quite a few times in the past. Right here after their earnings, after hearing their earnings, they kind of settled down. Again, here pretty much a sideways pattern, and then after their earnings back last year, it did about the same thing. So I'm expecting that they kind of settle down. Qualcomm isn't one of those ones that comes out with a lot of news, and it's held up rather decently for its implied volatility. It's still above 50, so that fits with my rules for the long call butterfly. We need an IV percent above 50, and that's what we have here. When I was looking at it in the webinar, it was just slightly below it. Today we got a little bit of a move up in implied volatility, and it's very close to this point of control. So if we get down to that point of control where the most time and volume's been spent, we could easily start seeing this get comfortable in that range. So I decided to go into that trade today rather as opposed to yesterday. It just didn't look as good, and today I was able to get into this trade. Went into the February contract for Qualcomm. The reason why I did that is because we want this to stay right where and pin at our mid strike. So I don't want to have a whole lot of time to have this trade go wrong. So I went into the February and I bought the 50 calls, sold 2 of the 52.5 calls for every 1 of the 55 calls. And that trade I paid a debit for 77 cents for that trade. So that fit all in line with my rules for that. As a matter of fact, I think I got better pricing than what we were even looking at in the webinar. So it doesn't always have to be the exact day that you're looking at, but put it up on your radar, keep your eye on it, and see how that works out. This one seems to be working out pretty good for that kind of trade. Then on to another trade that I'm looking at is Procter & Gamble. Actually got filled on this just before we went into the daily market commentary. And this market looks to me as the broader equities are showing weakness. There's going to be a lot of these staples, consumer staples, that are going to get a little bit of buoyancy as people pull out of some tech stuff, throw it into some of these consumer staples. And I think the Procter & Gamble is going to be one of those if we start seeing a big pullback to benefit from that type of environment. Also, with it creating this bottom here on, what was that, Tuesday, what was that be? That would have been Friday. This market has confirmed to the upside and gotten above this little line in the sand here, which is for the volume, where the most volume's been spent, the most time's been spent on here. But this is going to be a value area low for the volume where the most contracts have been traded. And I think that it's going to have that as a target to migrate back to. So I decided to put on a bullish spread, despite the fact, and also because my overall portfolio is very negative delta as I've been taking off some of these trades. It's working out quite nicely, but I need to stay diligent, kind of play around with some of my deltas, add some longer deltas to my portfolio in case this is just a fake out to the downside. And in that, I went into the March and bought the 87.5 calls and sold the 92.5 calls. I ended up paying $1.28 for that spread. Did it really small because I'm doing it as a debit spread, but that fits nicely because my risk reward is really good on this one. I'm risking $1.28 to make almost $8.72 for that on the upside if we can get that big move to the upside. Now, of course, my calls are really high on this one, and I did the calls that are just out of the money with the 87.5 calls, but if I can get it to go up maybe even test that value area high, blast through this area to test the value area high. That will work out quite nicely, kind of like that deer trade. Might not end up taking the full 50% of my max profit on it, but I can do that because I have so much profit potential in that trade. All right, gone a little bit long today. I hope I didn't bore you guys all to death. Friday's webinar is going to be on the long put butterfly, so check that out at protraderstrategies.com. I know we had a lot to go over, and that's all I got for you today, except for if you can't take that, take it easy.